Welcome back to Math Concepts. We are going to continue our discussion of the mathematics behind personal finance. In this video, we are going to talk about bonds. Okay, so several investment tools that you've probably heard about. Stocks, we discussed that in the previous two videos. Now we're going to talk about bonds. Now, when you buy a piece of stock, when you buy a share of stock, you are buying a little piece of a company. You are kind of becoming part owner of the company that you buy the stock in. A bond is a little bit different animal. A bond is a loan. Typically, a government will issue bonds. Let's say a city government wants to build a new, what would we call it? A new event center at their high school. So they need to raise money to build this new venue. So they take out a loan in the form of issuing a bond. So you can buy these bonds and then you will get repaid with interest. Okay, so let's look at some examples of dealing with bonds. So the key idea that you should take away from this video is how to calculate interest paid to bond holders. And remember, a bond is a little loan. It's a simple interest loan. So we actually know all the steps we need to do to calculate this stuff. Okay, so let's say a bond has a $15,000 face value, 4-year maturity, and 3.5% coupon. What is the total of the interest payments to the bondholder? Okay, so we're dealing with simple interest here, right? I equals PRT. Now, some of these words are a little different than what we had used before. They're just terms that are used when dealing with bonds. The face value is the amount of the loan. In other words, the principal. So we take $15,000. The coupon is the interest rate on the bond, 0.035. Remember, we have to convert that to decimal form. Okay, whenever we're doing a calculation with a percentage, we want to convert it to the equivalent decimal form. And the maturity is the length of the loan. Okay, so this $15,000 face value bond is a loan of $15,000 over 4 years at 3.5% interest. And we can just do that calculation there. So 15,000 times 0.035 times 4, 2,100. Okay, so that's the total of the interest payment that the bondholder would receive. So by buying this bond, you are agreeing to loan $15,000 to, if we use the example we talked about at the beginning of this video, $15,000 loan to build that event center. They're going to pay you back in 4 years, and you're going to get $2,100 worth of interest. Okay. You might also see questions asked like this. Obviously very similar. The only difference is this question is about finding the annual interest. So it's just 1 year's worth of interest. Even though it's a longer loan, they're asking how much will you get each year. Okay, well, we're still going to use the same simple interest formula, PRT. In this case, the bond is $6,000. The coupon or interest rate is 4.6%, which we convert to 0.046. This question asked us about annual interest rate, so it's 1 year. If we wanted total interest payments, then we would do 15, but it's just annual interest, so we do for 1 year. And then, of course, the 1 doesn't really matter, so we do 6,000 times 0.046 times 1 if you like, but that's not going to change anything. So you're getting $276 worth of interest for each year. Okay, and just some notes about dealing with bonds. Remember, bonds are simple interest loans, typically issued by governments, though they can be issued by corporations as well. The maturity date, that's the length of the loan. The coupon is the interest rate, and the face value of the bond is the amount of the loan.